On the 1st of January, Zach entered the cost of repairing equipment, $420 in the equipment account. So I put there error. Later we will know. On the 31st of December, depreciation of 20% per annum using the straight line method. Per annum means per year. And Zach used the straight line method. It was charged on the balance of the equipment account. What was the overall effect on the book value? Remember the book value of the equipment on the 31st of December. So first, of course, there are choices. You have the 84, which is the understated, 336 overstated, 420 overstated, 504 understated. Analyze first the analyze first the question. What was the overall effect? What is the effect of the book value on the equipment? Another is there is an error here. Why? Again, analyze. Zach, the business owner, entered the cost of repairing equipment. Cost of repairing the equipment. You've got an equipment, you repair it. It means that you restore on its working condition or repair. Okay, from the word repair, 420 in the equipment account. Now, look at this. It's because in accounting, repairs are not considered as capital expenditures, but as part of operational expenses. Again, let me repeat. The cost of repairing equipment, okay, of course, cost means expense, but this cost of repairing the equipment is not part of the capital expense, it's part of the operational expense. There's a big difference between capital expense and operational expense. Again, Zach made an error. And what is his error? He put the amount of 420, the cost of repairing equipment, in the equipment account. Now, the error here is that he should have put this cost, the 420, into a repair expense, okay, on the income statement, and it will be reflected on the income statement. Why? What's the difference between repairs and capital expenditures? Okay, when we say repairs like this, these are the expenses incurred to restore an asset to its original working condition or to keep it in a good repair. For example, you fix a machine, you repair the machine, or you replace some parts of the machine. That is part of the repair. And it is recorded as an expense in the income statement, okay, for the period in which the repair occurs. Why? Because repairs do not increase the value of the asset. Again, repairs like this example, cost of repairing equipment, will not increase the asset's value or the lifespan. Okay, you're just maintaining it to work on it. Okay, so that it's part of the operational expenses. When we say capital expenditures or capital expenses, these are the costs incurred to to significantly improve an asset. Again, so when we say capital expenses, these are the expenses that you incur because you want to improve it, you extend its useful life or adapt to a new use. So for example, if you're going to add new feature to a machine or to the equipment, then that is part of the capital expenses or expenditures. Or if you're going to renovate or paint the building so that you will sell it or you will rent it to other people, then it means that that renovation of building is part of the capital expenses. Or if you're going to upgrade an equipment, then therefore it's a capital expenditure, and it is recorded as an asset on the, not the income statement, but in the balance sheet, and it depreciates over its useful life, the value, right? Why? Because these expenditures or these expenses provide a very long economic benefits. So again, this part, cost of repairing equipment, is, it will not give you really literally long-term economic benefits, but it's rather, um you're just fixing it so that you can use it again. So again, let me repeat. Cost of repairing equipment is not a capital expenditure or capital expense, but it's rather part of the operational expense, or simply like repairs. Okay, again, capital expenditures are recorded in the equipment account for major improvements, upgrades, or extensions of the useful life of the equipment. So, on the other hand, repairs, like this example, is considered, you have to record it as part of the operational expense or simply repair expense, because it's just for the restoration of the equipment to its original functionality. So fixing something, then it means that fixing an equipment or fixing a broken part of the equipment is considered as repair and not part of the capital expenditures. So what happened? Okay, so this is the error. So Zach entered this cost on the other account, which is the equipment account. So it means that there's a mistake. There is a mistake. So it should be recorded as an expense in the income statement and not added in the equipment account. So what will happen? Of course, there will be overstating. The mistake will cause the equipment account to be overstated, okay? Over exaggerated by 420. So again, so you have 1, 2. So it's not understated but overstated. Again, book value of the equipment. We're talking about what will happen, what will be the effect of the book value. Obviously, there is the overstatement going on of 420. Okay, next is to calculate the depreciation rate, okay, on the overstated amount. So the depreciation rate is 20% per annum or per year, and using its straight line method. So since the repair cost was added on the equipment account, the depreciation was also charged on the 420 amount. So it means that if you're going to use a straight line method, 420, okay, times 20, because it's per annum, this is the depreciation rate, and convert this percentage into decimal, which is 0.20 or 20. So the answer is $84. Okay, now, of course, next is to determine the overall impact. So your answer here is not 84, okay? So this is like the depreciation, um yeah, when you multiply it in the depreciation rate per annum. Okay, so it means that because of this error, the equipment account and the depreciation amount are really incorrect. Because why? The equipment account was overstated by 420, which is the repair cost. Okay, then the depreciation charge on this overstated amount further reduce the book value by 84, which is this part. Now, what you need to do now is to subtract it, okay? So the overall overstatement in the book value is 336. Okay, Let me repeat. The equipment account was incorrectly, okay, inflated, meaning to say you put it on the equipment account, it was like increased by 420. Okay, and of course there is a depreciation charge of 84 because remember the 20% annum. This 84 was actually what was also wrongly applied to this amount. So again, this 420, you put it in the equipment account, there's an error. And then, of course, you will compute the 20% per annum using the straight line method. The answer is 84. So this 84 is also an error. Okay, so this combination leads to the book value being overstated by 336 at the end of the year. For the last time, okay, why the answer is 336 overstated? When we say that something is overstated by $336, it means that the recorded amount in the financial statement is higher than its true or accurate value, meaning to say you put it higher, okay, artificially, and in this case the book value of the equipment was shown to be 300. The book value of the equipment was shown to be 336 more than it should have been. Why? Because Zach made a mistake that he included 420 for repairs in the equipment account. Remember, it means that the cost of repairing equipment should not be put on this equipment account, but rather he must put it on the repairs account. Okay, so because of what happened, of course, there is the artificially increased the value of the equipment. So there's an overstatement of the equipment. Now, there is the depreciation of 20% annum using the straight line method. So when we computed how to use the straight line method, what you need to do is to multiply this, okay? So the answer is 84. So this $84 was wrongly applied to this overstated amount. Remember, this one has been overstated. So it means that it's reduced the equipment's book value slightly. So it means that the net overstatement in the book value became 420, which is the overstatement, minus $84, which is wrongly depreciated. That's why the answer is 336. This is a perfect example of an error, okay, and not following the matching principle. So if there is a overstatement in the financial records, it will really lead to inaccurate financial reporting, which means that in the end, it will mislead business owners, the decision makers of the company's actual asset values. So it means that we have to correct the error. So again, this is the error. This should be an operational expense and not a capital expense.